U.S. inflation has eased to its slowest pace in a year, marking a notable slowdown in price increases across the economy. This development suggests a potential respite for consumers and businesses alike as pressures from higher prices start to alleviate. As we monitor these trends, it'll be crucial to observe how this moderation in inflation shapes broader economic outlooks and policy decisions in the months ahead. June brought a significant easing in price hikes across the United States, suggesting a positive trajectory for the world's largest economy as it navigates away from the heightened inflationary pressures that followed the pandemic. Data from the Labor Department revealed a modest 3% increase in prices over the preceding 12 months, marking the slowest rate of inflation observed in a year. Data from the Labor Department revealed a modest 3% increase in prices over the preceding 12 months, marking the slowest rate of inflation observed in a year. This deceleration was largely influenced by lower energy prices, which played a crucial role in mitigating overall price growth. Continuing a trend observed over the past 3 months, the reduction in price inflation has persisted, offering significant relief to households grappling with financial pressures. This development also raises the possibility of the Federal Reserve contemplating an interest rate cut as soon as September. Since last year, the Federal Reserve has held its key lending rate above 5.3%, marking its highest level in nearly 2 decades. This prolonged stance reflects the central bank's efforts to manage economic conditions amidst persistent inflationary challenges. Federal Reserve officials have highlighted that the current high borrowing costs are acting as a significant constraint on economic activity, thereby playing a crucial role in alleviating the upward pressures on prices. According to analysts, the latest economic report may bolster the Federal Reserve's belief that its policy measures thus far have been effective in addressing inflationary pressures. This assessment could influence the central bank's future decisions regarding interest rates and monetary policy. From May to June, there was a noteworthy reversal as prices experienced a 0.1% decline, marking the first instance of a monthly drop in several years. This development comes as a welcomed relief for the White House, which has been grappling with extensive economic dissatisfaction amid the challenges posed by escalating living costs and higher interest rates. These factors have intensified financial pressures on households across the country. Over the course of the last year, the pricing landscape has shown a distinct pattern of fluctuation. Energy costs and automobile prices have seen declines, contrasting with continued upward trends in other essential commodities. During this period, grocery prices have experienced a 1.1% increase since June 2023, indicating ongoing inflationary pressures in the food sector. Meanwhile, housing expenses have notably risen by 5.1%, underscoring significant cost escalations associated with residential accommodation. During recent hearings in Washington, Republican lawmakers voiced their concerns to Federal Reserve Chairman Jerome Powell regarding the potential implications of a pre-election interest rate cut. They warned that such a move might be perceived as an effort to artificially bolster the economy in favor of the incumbent president. In response, Mr. Powell refrained from making speculative comments about the Fed's future actions, but strongly defended the central bank's political autonomy. He emphasized that the Fed's decisions are based on thorough analysis and interpretation of economic indicators rather than political considerations. During discussions with lawmakers, Jerome Powell underscored that a reduction in interest rates was likely the next course of action for the Federal Reserve, emphasizing the institution's careful monitoring of economic indicators beyond just inflation metrics. We're keenly attuned to the nuanced risks currently present, and our aim is to strike a balanced approach, Powell explained. Our decision-making process involves not only assessing favorable inflation data, but also sustaining a resilient labor market. In June, the U.S. unemployment rate surpassed 4%, marking its first rise above the threshold in over 2 years, signaling a shift in labor market dynamics amidst broader economic considerations. U.S. inflation has eased to its slowest pace in a year, signaling a welcome slowdown in price pressures. This development offers a potential reprieve for consumers and businesses alike. As these trends unfold, ongoing observation will be key in understanding their implications for economic stability and future policy decisions. Join our vibrant community and be in the know by subscribing to our channel for the latest news and captivating content.